Hello everyone. The Japanese yen is once again under pressure, with USDJPY trading near 162, its weakest level since 1996. So what's driving the sharp weakness? The biggest factor is the growing divergence between the Federal Reserve and the Bank of Japan. While several Fed officials continue to indicate that interest rates may need to stay higher to tackle persistent inflation, the Bank of Japan remains committed to an accommodative monetary policy. This widening interest rate gap continues to favor the dollar and encourage investors to fund carry trades using the low-yielding yen. Another major headwind is the recent escalation in the Middle East. The collapse of the US-Iran ceasefire and renewed military action have pushed crude oil prices higher. Since Japan imports almost all of its energy needs, higher oil prices increase the import cost, widen the trade deficit, and create additional demand for US dollar, putting further pressure on the yen. Now, technically on the daily moving chart, the USD-JPY pair remains firmly bullish. The pair continues to trade within an upward moving linear regression channel, and the prices continue to remain above its 25-day, 50-day and 100-day simple moving average, confirming the strong upward momentum. It is currently consolidating around 162.30, just below the 162.80 to 163 resistance zone. A decisive breakout could pave the way towards 164 levels, while the range between the 160.60 to 161 region remains a key support area. Markets are also watching for the possible intervention by Japan's Ministry of Finance. However, history suggests that intervention alone is unlikely to reverse the broader trend unless it is accompanied by a meaningful shift in the Bank of Japan's policy stance. Overall, the outlook for the yen remains cautious. Elevated oil prices, persistent policy divergence, and resilient US economic fundamentals are expected to keep the USD-JPY biased higher, with any short-term corrections likely to be temporary. Thank you and stay tuned for more updates.